How does credit card work? How does interest work? These are very common questions that people ask, and it is very important to understand how this works because there is a hidden trap in here that most people don't realize. So let me explain. First of all, when you use a credit card, you're borrowing money from the bank or the credit card company. They lend you money and they charge you interest on that money. Now, there are different types of interest rates. There is a fixed interest rate and there is a variable interest rate. Most people, when they get a credit card, they don't read the fine print. And in the fine print, it will say that if you miss even one payment, they will raise your interest rate to a penalty rate, which could be as high as 30%. So here's what happens. Let's say you have a credit card with a low introductory rate of 10%. You start using the card and you charge $100. After the first year, they raise your interest rate to 20%, but you still don't pay it off. And now it's too high for you to handle, so you decide to stop using the card. You decide to just pay off the minimum balance each month. Now, every month the credit card company will take a percentage of your available credit line and they will round it up to the nearest dollar. So for example, let's say your available credit line is $1,000. They might take 1% of that, which is $10. They will round it up to $11 and that's how much you owe. Now you might think that you're okay because you're paying off the balance. But you're not, because remember that $100 that you charged in the beginning. That is still there and they rate charging you interest on that. And now it is too high for you to handle. So you go into what is called a credit card trap, where you raise stuck with high interest debt. And you can't get out of it. Now, fixed interest rate means that the interest rate stays the same over the life of the loan. So be careful and read the fine print before you sign up for a credit card. If you like this video, give it a thumbs up and share it with your friends and family. Subscribe for more videos like this. Thanks for watching. For example, if you have a credit card and you charge $100 and the interest rate is 10% per year, then you will be charged $10 in interest. And if you don't pay off the balance, that $10 will be added to your balance. And then you'll be charged interest on the $110 and then it just keeps compounding. And you just keep getting deeper and deeper into debt. Now, most credit cards have what's called a variable interest rate, which means that the interest rate can change based on what the prime rate is. The prime rate is set by the Federal Reserve, and most credit card companies will offer you a lower introductory rate for the first, say, 6 months or a year. This is a trick to get you to sign up with them because once that introductory period is over, they will raise your interest rate to their normal rate, which could be significantly higher. Now, there are two ways to calculate interest. One is called simple interest and the other is called compound interest. With simple interest, the interest is calculated only on the principal amount. So if you borrowed $100 and the interest rate is 10%, you would be charged $10 in interest. With compound interest, the interest is calculated on the principal amount plus any interest that has already been charged. So let's say you borrowed $100 at a 10% interest rate. In the first year, you would be charged $10 in interest. But in the second year, you would be charged 10% interest on $110, which is $11. So you would be charged more interest than in the first year. Compound interest is what most credit card companies use to calculate interest. So as you can see, it is very important to pay off your credit card balance as quickly as possible before the interest starts compounding. Now, I want to share with you a hidden trap that most people don't realize. Now it's important to note that this is not the case with all credit card companies. Some of them are more predatory than others.